In 2023-2024, that's when we started seeing an increasing number of retail investors, individuals investing in treasury bonds, thanks to so many people who at the time started pushing forward the message of capital markets and the message of investing. 2024-2025, it helped us see a little bit more people investing in treasury bonds. And 2025-2026 was a very good success, especially given that interest rates at the time were extremely high. They were very attractive. It was easy to attract investors in treasury bonds. And so many people who have been investing, especially the last 1 year or the last 2 years, or even those who have been investing for the last potentially 3 years, one thing they have come to realize is if somehow, somewhere you buy just one treasury bond, it will only pay you twice in a year. And many people joined the treasury bond market when the 2043 bond, the 20-year bond, in July 2023 was issued issued. And for so many people, for so many of us, we have a big portfolio in that bond. Yet somehow, somewhere, we only have to wait Jan and July to get paid. Somehow, somewhere, the government and Bank of Uganda brought in the 25-year bond. The 25-year bond helped to solve one single important element. It made sure that we get paid in Feb and August. For some of us who started earlier on investing in treasury bonds, of course, Feb and August was not a problem because we had the 2033 bond. It was a 10-year bond in financial year 2023-2024. It pays in February and August. Also in financial year 2024-2025, the government brought back the 5-year bond which matures in 2029. That bond also pays in February and August. So February and August was covered, at least from those who were investing early on. But for so many people who joined the last financial year, the 25-year bond, which goes to 2050, was our way to enter the Feb and August. So if you had the two bonds only, the 20-year bond and the 25-year bond, that means in a year of 12 months, you could only get paid 4 months. Then somehow, somewhere, we had the 10-year bond. The 10-year bond, which is the 2035 in the last financial year. That was a very good bond because it meant that we can get paid in May and November. The current 10-year bond also, the 2037, pays in May and November. And the current 10-year bond, the 2037, was the 15-year bond in financial year 2023-2024. So you can see how the linkages are. So it meant that you could easily, if you have been in the market for the last 3 years, and you somehow, somewhere manage to buy those bonds and you target the primary market, you can get your 10-year bond, the 15-year bond, the 20-year bond, and the 25-year bond. It meant that you can get paid 6 times out of 12 in 12 months. You were sure you could get a bond for the Jan and July. You were sure you could get a bond for Feb and August. You were sure you could get a bond for May and November. And many people, that's what they have. Of course, for so many others who have an advisor like Kakande Alex, we could get them certain other bonds in different months, especially the June and the December. The bond, the 2034 bond, is a very good bond for people who want to get paid in June and December. And for some of us who have it, we do not want to let it go because that's the month that is hard to get by. Yet somehow, somewhere, within that history, the last 3 years, one of the big query and quest has been a bond that pays either in September and March or October and April. Because to so many investors, especially investors that cross over the 100 million portfolio, they start asking for more. Laddering becomes important. Cash flows becomes important. Being paid throughout the year becomes important. Bonds are starting to be not just another investment, but an investment that you can plan around almost everything. We can plan them around school fees. We can plan them around expenses like rent, like utilities. We can plan them around as a plan to replace our income for the people who are doing the FIRE movement. Financial investment, retire early. Right? So when you think about it that way, and that's why when the calendar, the new financial 2026-2027 came out, the first draft, one of our feedback was like to the Bank of Uganda, think about us. We need a bond that can start and pay us in March and September and in October and April. And indeed, they listened to us. So for the calendar year, financial year 2026-2027, July and August, we have been warming up. The actual auction and audit and investment is starting in September. Because on September 9th and September 10th, Bank of Uganda is bringing a new bond, is introducing a new bond, a 20-year bond that is going to replace the 2043 bond. That bond will mature, will go up to 2046. So in September 10th, for every single person that has been there looking, Alex, I want to ladder my portfolio. I don't get paid in March and September. This is the chance. Then on September 23rd and 24th, they will bring another new bond, the 15-year bond. So in September, that's now the financial year 2026-2027 is officially beginning in September. Why in July and August, they brought back the 20-year bond and the 15-year bond. They were the sacrificial lamb as they gave us time for government to bring in this new bond. And we thank them for whoever listened to our cries, and there's so many people who asked for that. Because the voice of the retail investor can no longer be ignored. But there is a caution when it comes to when they are introducing a new bond. On September 10th, that's when they will be bringing the 20-year bond. When a bond is the first time they are auctioning off the bond, the cut-off yield becomes the coupon rate. The cut-off yield is the lowest interest rate that has been bidded by a competitive bidder. So competitive bidders, who we call them the market makers, is mostly the commercial banks, NSSF, big institutional investors. Even you as an individual, you can be a competitive bidder if you can bid for more than 200 million. But we do not encourage it, especially if you do not understand how the market works. So the cut-off yield becomes the coupon rate. So we are going to go into the September 10th auction when we do not know what the coupon rate is going to be. Because the first time that bond is sold off, it is sold off at par. For every 100 you buy, you pay 100. There is no discount, there is no premium. The cut-off yield becomes the coupon rate. That's when we know the coupon rate. And there is a risk to that. Let's walk backwards a little bit of history. The history that many of us remember is the 25-year bond when it was first auctioned off on August 5th, 2025. That bond was auctioned off at a time when interest rates were as high as 17.5. The anticipation is if interest rates follow the normal trajectory, Bank of Uganda, we were celebrating, we were already in the mood to celebrate. We had anticipated the cut-off yield was going to be as high as 17, if not cross over to 18%. And retail investors, did we pour so much money into that bond? Over 50 billion. I still remember that day vividly, the 5th August 2025, when the results came out, when the 25-year bond had a coupon rate of 16% and a cut-off yield of 16%. Yet on the same day, they sold off the 15-year bond, and it came out at a cut-off yield of 17.65%. that a longer term bond, the 25-year bond, had a lower cutoff yield than the 15-year bond. The rules of investment and the yield were broken that day. But it wasn't the yield that was broken. It was so many people's dreams. I remember someone who said, Alex, I hate this bond. I'm like, man, 16% is still very good. We should celebrate it. They hated it because the anticipation, the expectation was high in that bond. And Bank of Uganda and the government of Uganda rejected so much bonds, so much bids, that they ended up squeezing the cutoff yield lower. So if we are to use that history, we can also go back to July 2023, when the current 20-year bond that came out at a 15% cutoff yield was first introduced. It was hard to explain, but at least at the time, very few people were investing in treasury bonds. It was extremely hard to explain. But that became the reality. So when you think about it that way, as you go on September 10th, have an expectation that potentially, the cutoff yield that will end up determining the coupon rate of the new 20-year bond might not be as high as we might anticipate. Now, let me give you what sometimes happens. What we call the market makers, the banks, the institutional investors, because for them they have significant amount of bids, that Bank A might bid 100 billion. It's allowed to set its price. Setting its price means setting your own yield to maturity. Let's assume Bank A asks for a yield to maturity of 17%. Bank B, 17.2%. Bank C, 16.5%. NSSF, 15.5%. Another institutional investor outside Uganda, 15.8%. Another institutional investor who is bidding a 30 billion, 15.25%. What Bank of Uganda does, it first accepts. It goes through all the competitive bids and it looks at the last. What Bank of Uganda does, it goes through all the competitive bidders. There are not so many. The maximum, let's say 100. And it filters them out to say who bidded the lowest price, the highest price or the lowest interest rate. So let's assume it's institutional investor B or NSSF at 15.25% or 15.5% or even 15%. Then they will accept that first. And that becomes what we call the cutoff yield, which means all the retail investors all of them will be accepted at the lowest asking yield of a competitive bidder. So all of us will follow through at that interest rate. Then they say, how much money do we want to buy to get in this auction? Then they start going through the different competitive bidders, accepting certain levels depending on the interest rate they asked for, or reject majority of them. What happened in the 25-year bond? Which is exemplary because you have to think about it this way, that the final cutoff yield is dependent on so many factors and it becomes the coupon rate. It's in the best interest of the government that the bonds should always have a lower coupon rate. So that's why the auction day, the first time the bond is being auctioned, is extremely important for the government. And them rejecting such bonds, that, especially if the cutoff yield is so high, I don't know if they can engineer a lower cutoff yield and bid it for themselves and say, this is what we are accepting. I don't know. I'm not part of the team and I'm not there, so I'm not going to speculate. But it's possible. Anything is possible when it comes to Uganda. So on September 10th, as you put in your bid for the new 20-year bond, As you celebrate, for the first time, many of us are going to start getting paid in March and September, either for the 20-year bond or the 15-year bond on 23rd March, September. Because those bonds, the fact that they are getting introduced in March, in September, that means the next time the first time they will pay a coupon will be in March. So those two bonds are extremely, extremely important in our ecosystem of laddering treasury bonds, because now all of a sudden we have bonds that are going to pay us in periods that we have been looking out for, that we have been searching for. But be careful. The 20-year bond on September 9th, September 10th will be sold off with the 10-year bond. Now, the good thing or the bad thing, already we are in the regime of low interest rates. The interest rates have been so low, they have been trending downwards, that do not expect the cutoff yield of the 20-year bond when it's introduced and what becomes its coupon rate to be above 16%. No. Already the interest rates are so down that automatically the cutoff yield on that 20-year bond and the 15-year bond will be lower. The question is, lower by what extent? Will it be 15, what it is right now? The problem is, if it comes out the cutoff yield at 15%, yet the 10-year bond might come out at a cutoff yield that is higher, that is 15.4%, it means someone who has bought a 10-year bond is better off. They might pay premium, but they are better off they're buying a 10-year bond that versus you was buying a 20-year bond. There is a 10-year gap. Are we about to see what ended up happening in August 5th, where the 15-year bond had a cutoff yield of 17.65% versus the 25-year bond having a cutoff yield and a coupon rate of 16%, and almost 165 basis point difference? It made a significant difference on August in 2025. What will it be? When the 15-year bond gets introduced on September 23rd, it will be introduced back with the 25-year bond. What will it be? For so many people, it's going to be a position of, should I buy the bond that will pay me in March and September, or should I go for the bond that pays me in February and August, the 25-year bond? If I already have the February and August, should I increase the March and September? The February and August, that will be the 25-year bond. At that point, it will be at a premium, but at a lower premium because it has just paid the coupon in August. What will it be? So as you go in, as you plan for a laddering, that all of a sudden we have an opportunity to ladder these bonds, do not forget the realities we deal with every single day on the auction. On the auction day, when the bond is first being auctioned. So the two bonds that are getting introduced in March and September. And so some people, they'll be like, can I first let it be introduced? And I know it's coupon rate, then I wait for it the next time they will be selling it off. Because the 20-year bond, it will be introduced on September 9th, and then Bank of Uganda will bring it back on 7th October. So at least on September 9th, you stay away from the catastrophes that happen on auction days when the bond is being introduced for the first time. Then September or 7th October, you buy it either at a discount or at a premium, but at that time you would know what its terms are, what its coupon rate are. Does it work for you? And does you being paid in September and March that important for you? But to so many people it is. To so many people it is. The 15-year bond will be introduced on 23rd September and will be reintroduced on 28th October. To some will be, should I sit it out on 23rd September, let the shenanigans happen, and I wait for it when it gets reintroduced? Like for so many people who bought the 25-year bond on August On 5th August, we got a coupon rate of 16%. When the 25-year bond got reintroduced in November 2025, it came out at 17.95%. At that point, the shenanigans had gone away. So it's extremely important on whatever decision you make. But at least we are truly, truly excited for. Finally, we are about to get, for so many retail investors, about to get a bond that pays in March and September that will help them to ladder their portfolio.